So I'm just going to offer you my perspectives on why we're spending a lot of time in Japan and have been doing so for a couple of decades now, and how this is relevant to our business, and maybe some perspectives on how it could be relevant for other Western companies' business as well. Quickly about our firm, of course, I have to say a few words about that. The Astrup Fearnley Group is a global company, mainly focused on the maritime and energy industries. We have offices in 14 countries, around 400 employees, and we have over 150 years of history. Our part of the firm, Fearnley Securities, was established in 1987. We are a leading full-service investment bank with focus on energy and maritime. We have also offices globally in New York, Singapore, and London. We are a member of the larger group, as I mentioned earlier, and you could say that our focus is very specific. What we have raised over $30 billion for in the last 10 years is specifically for shipping, offshore, and energy. We offer a wide range of services across equity, debt, and advisory. And I think, as many of you know, the maritime industry is a very global one. And this means that we need to find business opportunities not only in our own region, but all over the world. So Japan, as an island nation, has deep roots, deep maritime roots. At the same time, it's advanced by looking outward. It has a rich history, shipping being a critical part of the country's economy. Not too dissimilar from Norway. If you look at some of the main industries that our country, Norway, has, it also relies on the ocean and the maritime shipping for a lot of its exports, whether it's oil and gas or aquaculture. Japan, at the same time, like many other Asian countries, have in recent decades been looking outward for growing their businesses. The last decade in particular, we've seen that the Japanese maritime companies, whether it's shipyards, lenders, local owners, have been looking to overseas clients to find new opportunities. At the same time, this comes at a cost. You know, the entry barriers for companies like our own or other Western ship owners, operators, borrowers to do business in Japan, the entry barriers are high, and it requires a lot of investment over a long period of time. So we'd like to say that working the Japanese market is a marathon, not a sprint. This is just a typical example of how what the timeline looks like in the most optimistic case for sourcing capital from the Japanese market versus Western lenders and lessors to our industry. So typically we say that the shortest time you can spend in securing financing here is 3 months, whereas we have examples of transactions with Western debt capital providers that have taken as short as 10 days. So there's a vast difference, and for people wanting to transact quickly and flexibly, Japan is not the right place to start, but it certainly is the right source of capital for many other types of transactions. So it's highly relationship driven with a strong focus on long-term partnerships, and it requires building client relationships over time before you can transact. Japan represents a unique source of highly attractive capital once access and trust is established. So success in this market is driven by a long and steady effort, and that long-term nature is precisely its strength. So what we've seen is that once those relationships have been established and you have access to that capital, you can tap it regardless of where you are in the cycle, which is opposed to a lot of the Western capital sources that are more pro-cyclical. A little bit about our timeline here. We opened our Tokyo office in 2006. That's now close to 20 years ago. It was established by our shipbrokering affiliate with a view on servicing the local utility companies, the J3, the large operators, and sourcing long-term charters for our Western clients. In 2009, we did our first JV transaction in Japan, where we were capitalizing on that sort of outward-looking approach that I was mentioning earlier. Some companies here were certainly earlier in doing that than others. But be that as it may, in 2009, we found a local partner that we sourced a JV investment from into crude tankers with a European company. In 2016, we did our first structured capital deal here. We utilized the long-term capital in Japan to bootstrap our clients' equity to help drive yield compression. And what we saw was that there was actually flexibility in how you could structure these transactions, and there was a willingness to take a more long-term view than what we often see Western equity investors are taking. In 2018, we did our first bank debt deal. Prior to that, I would say that for us, the Japanese market was more a sort of lease financing-driven market. There was a lot of bilateral leases with Japanese local owners. We're still doing that business today. But we saw that the Japanese banks were also increasingly willing to do direct lending to Western borrowers. And of course, one of the advantages it being more relationship-driven is that it's less reliant on sort of the traditional credit metrics approach that a lot of the Western capital sources are taking, and more based on pedigree, management team, track record, and some of the softer factors. Now in 2025, what we're seeing is new structures. We see that there are a lot of capital providers offering competitive pricing and flexibility to high-class Western owners and operators. And we think that with that also comes a higher degree of relevance because there's an increased creativity and volume capacity. So I think when we started working in this market, we could see that the typical transaction size on the debt side was, $20 to $40 million. Today we are doing, $100 to $200 million transactions in the Japanese market, and I think that is, more in line with how we see the Western financing market for the maritime industry developing. So we've built a very long time building a lot of these relationships across a broad landscape of debt providers. So we typically divide them into three categories: the traditional banks, the financial institutions, and the industrial, call it lessors or investors. So you'll recognize many of the names on the left-hand side here, some of them household names, what we like to call mega banks. These typically offer traditional senior secured debt and more corporate-style lending. Then there is some overlap with the leasing companies that we see as both providers of traditional debt capital, at the same time looking at more creative structures such as synthetic leases and multi-tranche loans. You also have the JOLCO underwriters, the JOLCO market having been extremely active in recent years, especially for some of the larger transactions that you have seen sourced out of this market. And then lastly, we have call it the local owners and the larger ship owners here that provide a higher leverage, covenant-light, long-term capital, where you can often achieve long-term lease financing at, on a WACC basis, quite competitive terms. And I think this is an alternative that is, on a relative basis, substantially cheaper than their Western peers. But specifically, this type of client also takes quite a long time to build relationships with. So that is also certainly a marathon and not a sprint. So what we see is that having spent nearly 2 decades in this country or in this market, it's developing into more than just a source of debt capital. What we see today is that there are large strategic and industrial players that are looking for other types of opportunities with Western companies, not only providing debt, but also making investments through M&A style transactions, whether it's take private transactions for listed companies or private M&A opportunities. And this, I think, makes this market even more relevant for us as we transact with some of these players in Japan and explore new types of transactions. So, why we decided to make Japan a core market for ourselves. The Japanese players' counter-cyclicality has provided a reliable platform for us and our clients through, what I would call a fairly volatile industry with some pretty long and deep troughs. We experienced that our Japanese clients have been there for their Western counterparties through thick and thin. I think this is a very important feature. I think a lot of the capital providers, whether it's on the debt or equity side in the Western markets, are certainly shorter term in their thinking. And so we think this is a very good complementary feature that the Japanese, whether it's debt or equity providers, have in their approach. The relationships, as I mentioned, are extremely strong driver and important factor in this country. And I think those are not built over 6 months or 1 year. They take many years to cultivate. And we've experienced firsthand, when you've built a relationship and you enter into a more difficult or challenging time in the market or in the cycle, we have seen some of the Japanese capital providers step up for their Western clients in ways that we have never seen any Western lenders do. And I think in some cases that has provided the liquidity necessary for some of our Western clients to get through the troughs in the market or in the cycle. We also see new players emerging, introducing more flexibility and creativity. And I think traditionally we would not associate flexibility with Japanese ship financiers, but more recently we have seen that there's a growing extent of willingness to take a flexible approach. And we think that's a very important development or trend in keeping the Japanese capital providers more relevant in the global scene and to overseas customers. From our recent M&A transaction M&A transactions, we've observed a growing number of Japanese industrial and strategic investors adopting a more ambitious approach. So if you take some of the large operators, some of the large trading houses, we have seen that the need to recycle their capital into new growth opportunities, and looking outwards in doing that, we have seen willingness to make multi-$100 million equity investments into overseas companies. We've seen the willingness to provide acquisition financing. We've seen a willingness to do joint ventures across all shipping segments, actually. And we like that there's now an increasing willingness to think big and think strategically. So we kind of see this as a market that's serving all the facets of our business, not just equity, not just debt, but also equity and M&A. So we've had a physical presence in this country for almost 20 years, and we expect to be here for at least another 20 years. So for us, this is a core and strategic market that we expect to service for a long time. And to those of you that know us from before and have worked with us in this market, we'd like to thank you for your cooperation and look forward to many more fruitful years of working with you. Thank you very much.
Dimitri, come also.